Today, here comes higher rates, but hello again, it's Martin North from Digital Finance Analytics, where I've latest post covering finance and problem news with a distinctively Australian flavour, and we're showing our black background today in respect of the Queen's death. We had a series of important events this week which really underscored for me some of the central questions about inflation, inflation targeting, and central bank policy. So today I want to explore this in more detail as the ECB lifted rates by 75 basis points and the Dow closed higher on Thursday after struggling for direction as Federal Reserve officials, including Chairman Jerome Powell, vowed to continue the fight against inflation. The broader market was very choppy and struggled for direction, swinging between gains and losses as Treasury yields climbed on hawkish remarks from Powell, vowing to persist with rate hikes. In fact, Powell was speaking as part of an online conference for the Cato Institute and said that the Fed reiterated the need to persist with rate hikes to battle inflation and vowed to keep at it until the job is done.
I think it's worth going back and remembering, and I pointed this out in my remarks 2 weeks ago at Jackson Hole, 10 days ago, that what Paul Volcker did and the Fed did to finally get inflation under control followed several failed attempts to get inflation under control. And what had happened over the course of that long period of the Great Inflation is that the public had really come to think of higher inflation as the norm and to expect it to continue. And that's what made it so hard to get inflation down in that case. So it is very much our view and my view that we need to act now forthrightly, strongly, as we have been doing, and we need to keep at it until the job is done to avoid that. We think we can avoid the kind of very high social costs that Paul Volcker and the Fed had to bring into play in order to get inflation back down and set us up then for a long period of price stability. That speech, the point really there was to deliver a speech that was narrowly focused on inflation, more direct and a lot shorter than a typical Jackson Hole speech. And I thought that what was appropriate was a very, kind of concise and focused message. To your question, the message really was that the Fed has and accepts responsibility for price stability, by which we mean 2% inflation over time. That, again, to your question, the longer inflation remains well above target, the greater the risk that the public does begin to see higher inflation as the norm. And that has the capacity to really raise the costs of getting inflation down. So finally, history cautions strongly against prematurely loosening policy. I can assure you that my colleagues and I are strongly committed to this project, and we will keep at it until the job is done. I can also assure you that we never take into consideration external political considerations. We are accountable to the public through Congress. That's a very fundamental, important aspect of our work. But we do not. We focus solely on the goals that Congress has given us, and that's what we're going to do here.
The central bank wants a period of below-trend growth. So he was explicit about the need to tackle high inflation. And it's also worth noting that other Fed members, including those who tend to lead more dovishly, have also struck a hawkish tone. For example, Chicago Fed President Charles Evans on Thursday backed the idea of lifting rates to 4% by the end of the year. And over in Europe, the European Central Bank hiked interest rates by an historic amount, and President Christine Lagarde hinted it could do the same again as part of, quote, several future moves to escalate officials' attack against rampant inflation.
In the face of an inflation that is extremely high, that is of a magnitude and persistence across sectors of that nature, obviously determined action had to be taken. And this is very much in line with our determination to actually normalize monetary policy as we started back in December. So for those who consistently repeat that the European Central Bank is lagging behind, I contend that we are on a journey that started back in December, where we decided to put an end to the asset purchases under PEP and under APP, to move out of negative interest rates as we did back in July, and now to continue on our normalization path with a front-loading exercise that we conducted today, because we believe that the deviation from target is such that it warrants this front-loading. And we also decided that this was not an isolated decision, but that we would raise interest rates further. We didn't say that we would raise interest rates at 75% as if 75 was the norm. It is not.
Even with a far weaker growth outlook and price increases primarily driven by supply factors, policymakers intensified their aggression with a 3/4 point increase on Thursday that was an unprecedented monetary tightening step. The decision matched analyst expectations and brought the deposit rate up to 0.75%. The ECB joins more than 40 central banks that have increased interest rates by at least a 3/4 point in one go. If the data on our meeting-by-meeting exercise review suggests that we should take a high hike of interest rates, we will do so, Lagarde told reporters in Frankfurt. And addressing the question of how many decisions are several, she said that it's probably more than 2, including this one, but it's probably also going to be less than 5. Money market investors boosted wagers on further ECB tightening with bets of another 75 basis point move in October, reaching 40%. The September hike brings the deposit rate to 0.75% from 0%, and we had expected the level to be increased to 1.5% by the end of the year. That's our estimate of neutral. However, the statement and the press conference suggests it will end the tightening cycle higher than that, perhaps at around 2.25% in February. The decision marks the second consecutive assault on inflation that's seen Eurozone borrowing costs rapidly exit sub-zero policy conditions before rising further in the space of less than 2 months. The abrupt reversal follows accusations that the ECB reacted too slowly to inflation that began as COVID lockdowns ended and worsened when Russia invaded Ukraine. Determined action had to be taken, Lagarde said. Inflation remains far too high. The ECB raised its outlook for consumer prices this year and next, while slashing its forecast for economic expansion in 2023. The 0.9% projection for growth next year is still more optimistic than the 0.7% that's predicted by a number of economists. And in fact, some of them see advances of 0.4%. As the deposit rate rises above zero, the ECB also ended a system of so-called tiering that officials instituted in late 2019 to soften the effect on banks of negative monetary policy. A wider review will follow, according to Lagarde. Additionally, to prevent an abrupt outflow of government cash holdings, the ECB temporarily removed its 0% rate ceiling for remunerating their deposits. The ECB sees slower growth and faster inflation than it did in June. Thursday's decision highlights how ECB hawks have hardened their grip on the 25-member Governing Council, emboldened by another overshoot on inflation last month to 9.1%. That's more than 4 times the goal. Higher borrowing costs are unlikely to blunt the soaring energy prices, though, behind the spike, with potentially worse to come after Russia halted natural gas supplies through a key pipeline. But the fear is that inflation expectations could spiral without aggressive hikes that will become ever trickier to enact as Europe's economy stumbles. And this week already saw political pushback as Spanish Prime Minister Pedro Sanchez warned that monetary tightening must be made compatible with an economic recovery path. As the cost of living crisis saps demand, analysts foresee a euro-era recession starting this year, with some saying a downturn is underway now. The prospects for Germany, the continent's largest economy, are bleak due to the outsized reliance on the Kremlin for energy. While it has filled gas storage facilities more rapidly than targeted, they're not sufficient to exclude rationing during the winter. But even with Deutsche Bank Chief Executive Officer Christian Sewing warning the recession is coming, Bundesbank President Joachim Nagel wants the battle with inflation to be prioritized over economic growth. Higher rates may offer some support to the euro, whose slide below parity with the dollar, has made imports, particularly of commodities, more expensive. And in July, ECB officials widely noted that euro depreciation constituted an important challenge and implied greater inflationary pressures, according to an account of that meeting. Lagarde reiterated that the ECB doesn't target a specific exchange rate, but said it's very attentive to the situation around the currency. So the common theme from the central bankers is inflation must be contained. Indeed, Philip Lowe yesterday re-emphasised this imperative despite the impact in the short run because of the longer-term consequences in a speech he gave. He blamed the pandemic and the response for the misalignment between supply and demand and the need to curtail demand to meet supply, which requires higher rates. He did concede that the RBA misforecast inflation in recent times, but also made the point that most other economists did. He should have listened to my shows with John Adams back in 2020. One interesting point was the question and answer on household buffers, which underscores that they recognise most buffers are sitting with more affluent households and others will be severely impacted, as I often say, averages mask. And interestingly, Lowe's speech also mentioned that Australia's wage pressures remained subdued despite the tight labour market. And he argued that our economy is different from others, where wages growth is stronger, which the market has taken as he being less hawkish than elsewhere. Well, we'll see. Personally, I think we're trapped into following other central banks higher or risk squashing the Aussie dollar. But the deeper question is whether central bankers know what they're doing. And Mervyn King, who was at one time the Governor of the Bank of England, speaking at the same online event, was very critical of the assumptions underlying the attempt to control the current inflation cycle. He suggested that in fact central banks reacted wrongly to the COVID cycle in that demand and supply both fell. But more broadly, he also argues that economists are too reliant on their theoretical models as they try to fine-tune inflation targeting. He suggested the need to get back to fundamentals.
40 years ago, we were coming out of the Great Inflation, when inflation reached double digits or higher. The lessons learnt then were clear. Macroeconomic policy should aim at price stability and a sustainable fiscal position. Microeconomic measures, such as tax and labour market reform, should aim at improving the supply side. Over the next 10 years or so after that, monetary policy was given the explicit task of achieving price stability, and eventually all major central banks adopted, in one form or another, flexible inflation targeting. Since then, CPI inflation has averaged close to the 2% target until recently. Inflation in the industrialized world has now risen to close to or around 10%. So what has gone wrong? What have we learned? And just as important, what have we forgotten? I want to suggest that there are three key lessons from the past 40 years. First, inflation targeting is not a new theory of inflation, but it's a way of helping central banks to make decisions about monetary policy. Second, money matters. You can't explain inflation solely in terms of real variables, despite the attempts of very clever economists to do so. And third, the misuse of models has led to hubris about the ability of monetary policy to fine-tune inflation.
And ex-Treasury official Lawrence Summers from the US, also again talking at the Cato Institute seminars, also pointed to policy failure. Excess demand was predictable, he said, and it's created inflation to the high levels that we're experiencing. The central problem, though, he said, was a failure to act. But ahead, he thinks those higher rates might be a more effective path. And he spoke about the current habit of central bankers. Promises turn out false, and the loss of credibility follows. Forward guidance, he said, actually has very little impact in the real world. And he says central banks should be more humble.
I have become increasingly convinced in recent years that central bank communication has lost its way. I believe that an earlier generation of central bankers, Alan Greenspan, particularly Paul Volcker, understood what the Delphi oracles understood. That if you are perceived as omnipotent and omniscient, it is a good idea to keep your statements vague and oracular so as to not destroy an illusion that gives people confidence going forward. The current habit in the central banking community of frequent forecasts, frequent press conferences, reliance on forward guidance seems to me to be quite problematic, because inevitably forecasts turn out to be wrong, promises turn out to not be keepable, and the result is a substantial loss of credibility. The predictions made by the Fed in the spring of 2021 that interest rates would remain at zero well into 2024 seem to me to be a particularly extreme example of this phenomenon. The central difficulty with forward guidance, in my view, is that the markets don't believe it, so it doesn't have much of an impact on longer-term rates, and therefore not much of an impact on market behavior to stabilize the economy. On the other hand, central banks take their own forward guidance seriously and therefore are constrained feel constrained to adhere to the policies they promised, even when those policies, in light of subsequent conditions, look unwise. After all, central forward guidance is without content if the central bank will do what is best moment by moment. It is only with content if it is constraining and influencing of policy going forward. And that can only be justified if it has substantial benefits at the moment that it is provided, something that at this point I regard as being unproven. So my hope, in sum, would be for central banking policies that are more humble in recognizing inherent uncertainties, less trying to precisely forecast or guide than has been the case in recent years, that there will be a clear recognition of the need for resoluteness even if there is a significant price around the containment of inflation, and that a great deal of thought will go into the era we may be headed into of secular low real interest rates, where savings absorption is a central problem.
So the point I want to leave you with is this. Across the world, central banks are continuing to lift rates. Even in Australia, we will see more rate rises, although the markets are trying to decode a less hawkish low relative to the others. But I come back to my earlier point. If we allow our rates to stay lower relative to, say, the US, the UK, and elsewhere, that's going to damage the exchange rate. And if the exchange rate moves in that direction, we import inflation. Therefore, there are definitely limits on how the RBA is going to tackle this ahead. Therefore, I still think more rate rises are on the cards. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.